Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So how do I calculate those numbers? Well, again, I know my max gain, I know my max loss. I need to calculate my break even. Well, my break even on a spread is calculated in the case of a debit call spread by taking the main position. And when I say main position on a debit spread, I'm talking about the more expensive of the two legs. It's the expensive leg, whether that's a call or put, whether it's long or short is irrelevant. It's the expensive leg that drives your opinion. In this case, the expensive leg is the 107 call. That one costs $4.30. So I bought that leg. That means I'm long a call. That means I'm bullish. So I take the expensive leg and I add the amount of the debit to the strike price. That's how I determine the main position. Or I'm sorry, that's how I determine the break even. So my main position is a 107 strike. I paid $2.31. That sets my break even price at 109.31. 109.31 is where the bottom of that orange bar is. The maximum gain we talked about on the previous slide, maximum gain occurs when you hit your objective, which is you have both options in the money. Well, where does this index need to be in order for both options to expire in the money? Well, it needs to be above the higher strike, which is 110. So the top of that orange bar corresponds to 110. So if my index is above the bottom of the orange bar, I'm profitable, and if it's above the top of the orange bar, I'll have my max profit at expiration. Well, you can see right now by looking that the index is already above that orange bar, right? And that's because both these options are already in the money. It's above the orange bar by 10 cents. So it's at its max profit zone right now. So even though this is a bullish strategy, all it really has to do is be not bearish. All the index has to do is not go down. And even if it does go down, it just needs to not go down more than wherever the bottom of that orange bar is. And the bottom of that orange bar is at 109.31. So if this index stays above that, I'll actually be profitable. And if it stays above 110, I'll hit my max profit. Now, where does my max loss occur? Well, the max loss occurs when both options expire out of the money. Because since I paid a debit, if both options expire out of the money, the entire amount of my debit that I paid is going to be lost. Well, in order for both of these options to expire out of the money and expire worthless, this index would have to drop all the way down below the lower strike, which is 107. So in fact, that's actually even down below where I put my support line in. I don't know exactly where my support line is, but based on my picture, it looks like it's somewhere around 107.70, right? It's right about in line with that number on the right. So this index would actually have to go all the way down below my support line in order for me to hit that max loss number. The odds of it doing that are significantly lower than the odds that it will stay above the orange zone where it's already at. So you can see just by that comparison how much more difficult it would be to lose the $2,310 than it would be to make the $690. Now here's an interesting thing. If you look at the max gain to the max loss, the ratio or the multiple of the max loss to the max gain, in this case it's about what? 3 times, right? I don't know exactly, but about 3 times 69 is about 231, something like that. Since the maximum loss is about 3 times the maximum gain amount on a vertical spread, what you can conclude from that is that the probability of the max gain is about 3 times the probability of the max loss. Now, that's a pretty interesting thing. So what I want you to take from that is don't evaluate the merits of a vertical spread strictly by looking at how much am I risking relative to how much can I lose. What you have to do is flip that number over and realize that if you're risking 3 times as much, then that means the chance of making a profit is 3 times higher. And that's going to be true of any kind of vertical spread. And I'll show you that a little bit on the next example. All right, so let's say that, okay, I can see that this index was well above this orange zone in December, and it was certainly well above it way back in August and September and even early October. So I think it has a very good chance to get up there. Now, it'd be nice to make $690, but if I had a much more bullish perspective, if I believed this index could go even higher and that it would get back into some of the zones that it had been in previously, wouldn't it make more sense to put on a spread where I could make more than 690? There's nothing wrong with making 690 unless it goes a lot higher and I could have made 1300 or something, right? So how would I do that? Well, I take on a slightly more aggressive approach. I put on another debit call spread that's a little bit more bullish. So instead of buying 107s and selling 110s, how about if I buy 109s and sell 112s? This is still a debit spread because I'm still buying the lower strike. I'm still buying the more expensive leg, but I'm moving my strikes up. I'm creating an at-the-money spread where my leg that I buy is in the money, but the leg I'm selling is out of the money. In this example, it's also a 3-point spread, the difference between 112 and 109. The net debit on this spread is $1.64, significantly cheaper than the other spread. This is a more aggressive spread, so it costs me less money, has the potential to make a higher profit, but it's going to require more movement in the index in order to make a profit. So how do I calculate my break even? Well, again, it's the main position or the more expensive leg, which is the 109. Add the debit of $1.64, and I get the break even price at 110.64. Well, you can see how much more aggressive this trade is when you compare it to the previous one. The previous one, I had to get to 110 to hit my max profit. My break even was below my max profit line. Now, the index is at 110.10, but I got to get up to 110.64 just to break even. In other words, I need a 54% movement higher in the index just to get to break even. And where do I have to get in order to hit my max profit? Well, I got to get all the way up to 112 or beyond, because again, my goal on a vertical debit spread is to have both options expire in the money. That occurs when the index is above 112. So if you look at the lighter colored beige bar down below, that illustrates the break-even to max profit zone where this index would need to be in order for you to be anywhere between break-even and max profit. If you're above that beige area, then you're in max profit for sure. But the profit caps out at the top of the beige bar. Well, you can see that where the index is right now on its most recent candle, that it's not in that zone at all. It's going to have to move 54 cents higher just to hit the bottom of that beige zone, and then it can move from 110.64 all the way up to 112. That's the beige zone. That's where I go from having a break even to hitting my max profit zone, and then anything above 112 is max profit on up. Now, the reason it's useful, and I find it very helpful to visualize this trade, is to put those little bars on there and to see visually where this index needs to go. Now, if you can look at that index and see that range and say, does it seem reasonable to me that that thing could be in that beige area or above by expiration? If your answer is yes, then you probably want to do the at the money or the more aggressive trade. If you're going, no, I like this index, I think it's pretty solid, and it's probably going to at least stay flat and maybe go up a little bit, but I'm not so sure that it's going to get up into that beige area, then you probably want to be a little bit more conservative, and you put on the more conservative trade, which is the orange one. But look at the difference. The orange one can only make $690. The beige trade can make $1,360. The orange one has $2,310 at risk. The beige trade only has $1,640 at risk. Okay? So where the first one had about a 3-to-1 max gain to max loss ratio, the second one's a lot closer to 1-to-1, right? I mean, it's got a little bit larger loss than gain, so your odds of making a profit are a little higher than they are of making a loss, but not significantly. This one's pretty close to almost a 50-50.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.